Today, we're tackling something pretty big, a kind of masterclass. We're aiming to distill the core ideas, maybe even some advanced stuff you'd find in a top MBA program.
Yeah, think of it as getting the essence, the key business concepts that work across different industries.
Exactly. So whether you're prepping for a big meeting, trying to get a handle on a new field, or maybe you're just curious, our goal is to give you practical steps, those cross-industry principles, and, the main takeaways.
And we want to do that without making it feel overwhelming, right?
Yeah.
No drowning in jargon.
Definitely. So what are we drawing on for this?
Well, we've pulled together information from introductory MBA guides, think the for dummies type books, all the way up to broader notes covering core disciplines, and even some pretty advanced strategic thinking.
Okay, and the approach.
We're structuring it like you might find in a top MBA program. So modules covering key areas. We'll focus on explaining things clearly, hitting the key concepts and frameworks, showing how they apply in the real world, and pointing you towards ways to learn more for business or investing.
Sounds good. Let's jump into Module 1 then. Accounting and financial reporting, often called the language of business, right?
That's the one. And, a lot of people just think, oh, accounting, that's just bean counting for taxes.
Yeah, keeping score.
But these sources really highlight its role as a strategic tool. It's for leadership.
How so? What makes it strategic?
Well, it's more than just looking backward. It's about using that financial information to make smart choices going forward. Think about resource allocation, deciding where to put money.
Like product development, or which markets to go after.
Exactly. Or even timing sales pushes, deciding where to focus geographically. All those decisions can be guided by what the accounting data tells you. It's about strategy.
Okay, let's get down to basics then. The absolute cornerstone seems to be the accounting equation. Assets equally liabilities plus equity. Can we break that down simply?
Sure. It's like the fundamental building block. Assets are basically everything the company owns or controls that has value.
Cash, machines, buildings, what customers owe you, inventory.
Yep, all of that. Things that are expected to provide future benefit. Liabilities are what the company owes to outsiders' debts, obligations from past deals,
Okay.
and equity. That's the owner's slice of the pie. It's what's left over for the owners after you subtract all the liabilities from the assets. It's their residual claim.
And the key thing is it always balances.
Always. That's the foundation of the balance sheet. It has to balance. It gives you that snapshot of financial structure at one specific moment. Really basic, but investors use it constantly to check leverage and ownership stake.
Right. And this equation leads us to the main financial statements. We've got the balance sheet, income statement, and statement of cash flows. Quick rundown.
Okay, so the balance sheet, like we said, is that snapshot. Assets, liabilities, equity at a point in time. You use it to gauge liquidity. Can it pay its short-term bills?
Yeah.
Solvency, its long-term stability, and just its overall financial health.
Got it. Snapshot. Then the income statement.
That shows performance over a period, a quarter, a year. It lists revenues coming in, expenses going out to earn that revenue, and the bottom line, net income or loss.
Profitability.
Exactly. And you can dig into trends there. Look at gross margin, how much profit from core products.
Okay.
Operating margin, how efficient are the operations. Net profit margin, the final profit after everything.
You mentioned something interesting there. A declining gross margin could signal trouble.
Yeah, it could mean your production costs are creeping up, or maybe you're facing more price pressure from competitors. It's an early warning sign, potentially.
Okay. And the third one, statement of cash flows.
This one tracks the actual cash moving in and out. Super important. It breaks cash flow down into operating activities, the day-to-day business.
Making and selling stuff.
Right. It's an investing activities. Buying or selling long-term things like machinery or buildings. And financing activities, dealing with debt, equity, paying dividends.
Why is this so crucial if you already have the income statement showing profit?
Because profit isn't always cash. A company can look profitable on paper, but be burning through cash. Maybe they're recognizing revenue really aggressively before the cash comes in, or maybe unsold inventory is piling up. The cash flow statement tells you if the business is actually generating the cash it needs to survive and grow. Negative operating cash flow when you're reporting profits. That's a red flag.
Makes sense. Now, these statements aren't just made up randomly, are they? There are rules. GAAP and IFRS.
Exactly. Rules of the road. GAAP, generally accepted accounting principles. That's the standard in the U.S. IFRS, International Financial Reporting Standards, used more globally.
And why have these standards?
Consistency and comparability. So you could actually compare Apple and Samsung or Ford and Toyota and know they're basically speaking the same financial language. It makes the information reliable.
Are there key principles underpinning these rules?
Yeah, a few big ones. The accrual principle is key. You record revenue when you earn it, and expenses when you incur them, not necessarily when cash changes hands.
Ah, so that disconnect between profit and cash again.
Precisely. Then there's the matching principle. You try to match expenses to the revenues they help generate in the same period. And the cost principle, generally, you record assets at what you originally paid for them, their historical cost. These help create a fair picture.
Okay, that seems focused on reporting to outsiders, investors, banks. What about using this info inside the company? Managerial accounting.
Good distinction. Yeah, managerial accounting is for internal use. It helps managers plan, make decisions, control operations. Financial accounting looks outward. Managerial looks inward.
What kind of tools does it use?
Things like budgeting, setting targets, planning spending, cost volume profit analysis, or CVP, understanding how costs, sales volume, and profit relate. Helps with pricing, figuring out production levels.
Like break-even points?
Exactly. And variance analysis, comparing actual results to the budget or plan. Spotting where things went better or worse than expected.
So it's not just about reading the numbers, it's using them. Financial ratio analysis comes up here too.
Definitely. This is where you take those statement numbers and calculate ratios to really dig into performance. You group them into categories.
Right.
Liquidity ratios, like the current ratio or quick ratio,
Okay.
tells you about short-term bill paying ability. People often look for a current ratio, maybe 1.5 to 2, quick ratio around 1, roughly.
Okay. What else?
Efficiency ratios, inventory turnover, days sales, outstanding, DSO. How well are you managing inventory and collecting cash from customers? Profitability ratios, return on assets, ROA, return on equity, ROE. How much profit are you squeezing out of your assets and the owner's investment?
And risk.
Leverage ratios, debt to equity, interest coverage. How much debt are you using and can you afford the interest payments? Tracking these over time, comparing to competitors, that gives you real insights. A falling inventory turnover, for example, might mean stock isn't selling.
And businesses use these practically, like variance analysis.
Oh yeah. If your labor costs come in higher than budgeted, an unfavorable variance, management needs to know why. Was the wage rate higher? Did people take longer than expected? An efficiency variance, you investigate and fix it.
And budgeting.
Fundamental. Companies might do it top-down, execs set the targets, or bottom-up departments build their own, or zero-based, justify every dollar every year. Whatever the method, it's crucial for planning and control.
This is a solid foundation if someone wants to go deeper on accounting.
The sources suggest some good textbooks like Libby in short for financial, or Garrison, Noreen, and Brewer for managerial. Online, Coursera, EDX, Harvard Business School online have courses.
Videos.
Khan Academy is great for basics. Harvard Business School's YouTube channel too. Lots out there.
All right, great. Let's shift gears. Module 2, finance. The sources call it value creation through capital allocation. Sounds like where the action happens.
It really is. Finance takes that accounting info and uses it to make decisions about raising money and investing it, all with the goal of creating value. And maybe the most fundamental concept here is the time value of money. TVM.
Right, TVM. Heard it a million times. The basic idea.
Simple but powerful. Money today is worth more than the same amount of money in the future.
Because you could invest it and earn a return. Or inflation erodes its value.
Both, exactly. Understanding this is crucial for almost everything else in finance. Calculating present value, what's a future cash flow worth today? Future value, what's an investment today worth later? Valuing annuity streams of payments, even perpetuities payments forever.
Okay, so how does TVM help companies decide where to invest? Big projects, new equipment?
That's capital budgeting, the process of evaluating those big, long-term investments. And there are key tools for it. Net present value, or NPV, is a big one.
How does NPV work?
You forecast all the future cash flows you expect from a project. Then you use a discount rate, reflecting TVM and risk, to figure out what those future cash flows are worth in today's money. Add up those present values, subtract the initial cost of the project.
And if the result is positive?
If NPV is greater than 0, it generally means the project is expected to create more value than it costs. So you lean towards doing it. It directly answers, does this investment make us wealthier?
Makes sense. Any other tools besides NPD?
Yeah, there's the internal rate of return, IRR. That's the discount rate that would make the NPV exactly 0. The rule of thumb is if the IRR is higher than your required rate of return or hurdle rate, the project looks good.
Okay.
And there's the payback period. Much simpler, just asks how quickly you get your initial investment back in cash. It's more of a quick risk check, less sophisticated than NPV or IRR.
Could you walk through a quick NPV example? Super simple.
Sure. Let's say a company considers buying a machine for $500,000. They expect it to generate extra cash flow of $150,000 per year for 4 years. Their required return, their discount rate, is 10%.
Okay.
You take each of those $150 payments and discount them back to today's value using that 10% rate. Year one's 150K is worth less today, year two's is worth even less, and so on. You add up those present values.
And compare the total to the $500,000 cost.
Exactly. If the sum of the present values is, say, $530,000, then the NPV is $30,000 positive. Suggests it's a value-creating investment.
Got it. So that's evaluating one project. What about valuing a whole company? Valuation method.
Right. Several ways to do that. Discounted cash flow, DCF, is a major one. Very fundamental. It applies the same TVM logic.
Yeah.
You forecast the company's future free cash flows, the cash available after running the business and reinvesting. Then you discount those flows back to present value using the company's overall cost of capital.
What about way out in the future? You can't forecast forever.
Good point. That's where the terminal value comes in. It's an estimate of the company's value beyond your specific forecast period, often calculated using a perpetuity growth model or an exit multiple. It's a huge chunk of the value in many DCFs.
Okay. What other valuation methods are common?
Comparable company analysis, or comps. You look at the valuation multiples like price-to-earnings ratios of similar publicly traded companies and apply them to your target company.
Makes sense. What else?
Precedent transactions. You look at what prices were paid for similar companies when they were bought or sold in the past. And there's asset-based valuation, more relevant for some types, where you sum up the value of the company's assets and subtract liabilities.
Finance also talks a lot about risk and return. What's the core idea there?
The fundamental trade-off. Higher potential returns usually come with higher risk. Can't have one without the other, generally.
How do MBA programs explore this?
Through things like portfolio theory. The idea is that you don't put all your eggs in one basket. By diversifying investments across different assets that don't move perfectly together, you can reduce overall risk, specifically unsystematic risk, the risk tied to a single company or industry without necessarily giving up expected return.
And CAPM, Capital Asset Pricing Model.
CAPM is a model to figure out the expected return you should demand for investment based on its systematic risk. The risk you can't diversify away, the market risk. It uses a measure called beta to quantify that risk relative to the overall market.
You mentioned discounting cash flows using the cost of capital, WACC, weighted average cost of capital.
Yep, WACC. That's the average rate of return a company needs to generate to satisfy all its investors, both the people it borrowed money from, debt holders, and the owners, equity holders. It reflects the riskiness of the company overall.
And it's the discount rate used in DCF?
That's right. It's critical for bringing those future cash flows back to present value accurately.
What about capital structure and dividend policy? How companies fund themselves and pay shareholders?
Capital structure is about the mix of debt and equity a company uses. Finding the optimal mix is tricky. Debt offers tax benefits. Interest payments are usually tax deductible. But too much debt increases financial risk, the risk of not being able to make payments.
So there's a trade-off.
Exactly. The trade-off theory tries to explain how companies balance these factors. Dividend policy is about what the company does with its profits. Pay them out to shareholders as dividends, or reinvest in the business, or buy back its own shares.
What influences that decision?
Lots of things. How much financial flexibility does the company need? What do its shareholders prefer? Does changing the dividend send a signal to the market about future prospects?
And financial modeling seems like a big practical skill.
Hugely important. Building models in Excel, especially DCF models or models for leveraged buyouts, LBOs, is a core skill in finance roles. It lets you test scenarios, understand sensitivities, and really analyze decisions financially.
Okay, so how does this stuff play out in the real world? Capital structure.
Companies constantly think about it. Different industries have different norms. Utilities can often handle more debt than volatile tech firms. Credit ratings matter a lot. Adding more debt might lower your WACC initially because of the tax shield, but it definitely increases risk. It's a balancing act.
And deciding on dividends.
Executives look at cash flow stability, growth opportunities, shareholder expectations. Some aim for a stable dividend per share. Others pay out a set percentage of earnings. Some do regular plus occasional special dividends. Share buybacks are another popular way to return cash.
What about getting really good at DCF? Any nuances?
Oh, absolutely. Choosing the right terminal value method is key. Calculating WACC accurately means considering country risk, size premiums, maybe company-specific risks, Details like using a mid-year convention for cash flows, deciding the explicit forecast length, maybe using a two-stage growth model for companies evolving over time. Lots of judgment involved.
Wow, okay. Resources for digging deeper into finance?
Classic texts include Rosenbaum and Pearl on investment banking and Brealey, Myers, and Allen's Principles of Corporate Finance. Online, Wharton on Coursera, ACCA on edX have solid courses.
Videos, tools.
Wall Street Prep has practical tutorials. Aswath Damodaran's lectures on valuation are legendary. Find them online. Tool-wise, Excel is non-negotiable. And for professionals, a Bloomberg terminal is invaluable for data and analytics.
Excellent. Let's move to Module 3, Marketing. Subtitle: Creating and Capturing Customer Value. This feels like connecting the company to its customer.
It absolutely is, and it's way more than just ads and slogans. MBA-level marketing is about deeply understanding customer needs, sometimes framed as the jobs-to-be-done concept.
What job is the customer hiring the product to do?
Exactly. And then strategically developing, pricing, distributing, and promoting offerings that really meet those needs, creating value for both sides.
A core framework here is STP: segmentation, targeting, positioning.
Yep, fundamental. Segmentation means breaking down the broad market into smaller groups with shared characteristics, demographics, lifestyle, buying behavior, whatever makes sense.
Then targeting.
That's choosing which of those segments you're going to go after. You might target broadly, undifferentiated, go after several segments with different approaches, differentiated, focus on one niche, concentrated, or even target individuals, micro-marketing.
How do you choose?
You evaluate the segments. How big are they? Are they growing? How tough is the competition? Can we actually serve them well? Companies often score segments on criteria like these to prioritize.
And positioning.
That's about carving out a specific place in the target customer's mind for your product relative to competitors.
Yeah.
What makes you different and desirable? You craft a positioning statement.
Like the Volvo example, safety for families.
Perfect example. Target audience, safety-conscious families, frame of reference, premium cars, point of difference, safest experience, reason to believe, features, reputation.
Okay, so once you know who you're targeting and how you want them to see you, you use the marketing mix, the 4 Ps.
That's the toolkit: product, price, place, promotion. These are the tactical levers. Product covers features, quality, branding, packaging, service. Price involves setting the right level, maybe cost plus, maybe value-based, and tactics like dynamic pricing or penetration pricing.
Place is distribution.
Right. How does it get to the customer? Direct online sales. Through retailers, wholesalers. That's place. And promotion is how you communicate advertising. ATL above the line, sales promotions, PR, BTL below the line, personal selling, and increasingly integrated digital campaigns. Omnichannel is a big buzzword seamless experience across all touchpoints.
Branding seems to weave through all of this.
It really does. Branding is about building that perception, that value associated with the name, the brand equity. Strong brands build loyalty, can charge more, and are hard to copy. It's a huge asset.
And today, digital marketing is essential.
Absolutely critical. SEO, SEM, social media, email, content marketing. You have to be where your customers are online, engaging them effectively.
But how do you know if any of this is working? Metrics and ROI.
You have to measure. Key metrics include customer acquisition cost, CO's SE. What does it cost to get a new customer? Customer lifetime value, CLV. How much is a customer worth over their entire relationship? And marketing ROI, are your marketing dollars generating a good return?
What about customer journey mapping and the value proposition canvas?
Useful tools. Journey mapping visualizes the customer's entire experience with the company, from awareness to post-purchase, helps spot friction points and opportunities.
And the value proposition canvas.
That helps ensure your product, your value proposition, actually solves the customer's problems, their pains, and creates the benefits they want, their gains. It forces you to align what you offer with what customers actually need.
So putting it all together, what's the strategic marketing planning process look like?
It typically starts with a situation analysis, looking inward at strengths, weaknesses, and outward at customers, competitors, the market. SWOT analysis often summarizes this.
Okay.
Then you set objectives, smart ones. Specific, measurable, achievable, relevant, time-bound, like increase market share in segment X by 5% in the next fiscal year.
Then strategy.
Yep. Define your STP, craft your value proposition, outline the marketing mix strategy. Then comes tactical planning, the specific actions, budgets, timelines for each P.
Implementation and control.
Put the plan into action and monitor progress using KPIs on dashboards. Adjust as you go based on results.
And how do you make positioning real, not just a statement on paper?
You have to live it. Understand customer perceptions,
Yeah.
know how competitors are positioned, find your unique angle, create that statement, test it, and then critically translate it into everything you do.
Right.
Product design, pricing, channel choices, ad campaigns, it all has to reinforce that desired position.
Very clear. Resources for marketing.
Kotler and Keller's Marketing Management is a standard text. Riesentraut's Positioning is a classic. Look for lectures from places like Stanford GSB. And HBR case studies like on Tesla's marketing offer great real-world learning.
Okay, Module 4, Operations Management. Designing and managing business processes. This sounds like the engine room, how things actually get made and delivered.
That's a great way to put it. Operations is about the efficiency and effectiveness of the systems that create and deliver goods or services, how the work gets done smoothly.
Supply chain management is a big piece of this.
Huge. It's managing the whole flow, from sourcing raw materials through production and all the logistics to get the final product to the customer. Coordinating all those players and processes to be efficient and responsive.
Inventory optimization, always tricky.
Always a balancing act. You need enough inventory to meet demand, but too much ties up cash and adds costs. Storage, insurance, risk of it becoming obsolete. The EOQ formula, economic order quantity, is a classic tool to help find the optimal order size, balancing ordering costs and holding costs.
And logistics network optimization, that's about warehouses and trucks.
Basically, yes. Designing the physical network. Where should warehouses be? How many? What transport modes? Truck, rail, air, sea? How do you structure it all to be cost-effective and meet delivery promises?
Quality management seems essential too.
Can't succeed without it. It's about ensuring your products or services consistently meet customer expectations.
Yeah.
Building quality in, not just inspecting it out. Processes for control, prevention, and improvement.
We heard about continuous improvement approaches. Lean, Six Sigma, Kaizen, quick definitions.
Right. Lean is focused on ruthlessly eliminating waste. Anything that doesn't add value for the customer. Six Sigma is very data-driven, aiming to reduce defects and process variation to near perfection.
And Kaizen.
That's a Japanese philosophy of continuous, incremental improvement involving everyone in the organization. Small changes, constantly. Six Sigma often uses the DMAIC methodology. Define, measure, analyze, improve, control a structured way to tackle process improvement projects.
And project management fits in here too.
Definitely. Many operational improvements happen through projects. So knowing how to plan, execute, and control projects, managing scope, time, cost, resources is vital. The 5 phases are usually initiation, planning, execution, monitoring and controlling, and closing.
How does this look in practice? Inventory management.
Well, you manage different types. Raw materials, work in process, WIP, finished goods, MRO supplies for maintenance. You use systems like continuous review or periodic review, maybe ABC analysis to focus on high-value items, or just-in-time, JIT, to minimize holding inventory.
Project management process.
That 5-phase structure provides a roadmap for any project, big or small. Ensures you define what you're doing, plan how, execute the plan, track progress, and wrap it up properly.
And applying Lean or Six Sigma.
Through specific techniques,
Wow.
facilitating Kaizen events-focused workshops to solve a problem quickly, value stream mapping to see the flow and find bottlenecks, A3 problem solving for structured analysis, Hoshin Kanri for aligning improvement efforts with company strategy. Lots of tools.
Resources for operations.
Heiser and Render have a widely used textbook. Eli Goldratt's The Goal is a classic, reads like a novel but teaches key concepts. Chopra and Meindl on supply chain. Online, Wharton on Coursera, MIT on edX, videos from MIT OpenCourseWare, ASQ, American Society for Quality.
Okay, last module, strategy. Achieving sustainable competitive advantage. This feels like the ultimate goal, tying it all together.
It really is the big picture. Strategy defines the long-term direction. Where are we going? How will we compete? And crucially, how do we build an advantage that lasts, that competitors can't easily copy? It needs deep understanding of the outside world and your own capabilities.
And there's a whole toolkit of frameworks.
Yeah.
Porter's 5 Forces seems famous.
Very much so. It helps analyze the industry structure, threat of new entrants, power of suppliers, power of buyers, threat of substitutes, rivalry among existing competitors. Understanding these forces helps you see the industry's attractiveness and where the competitive pressures are.
SWOT analysis. Strength, weaknesses, opportunities, threats.
A fundamental. Helps organize thinking about the internal situation, strengths, weaknesses, and the external environment. Opportunities, threats. Good starting point for strategic thinking.
Blue ocean strategy sounded interesting, creating new markets.
Yeah, the idea is to stop fighting bloody battles in existing markets, red oceans, and create new, uncontested market space, blue oceans, where competition is irrelevant. The Strategy Canvas tool helps visualize how you can offer different value.
What about competitive positioning maps, value chain, and VRIO?
Positioning maps help visualize where you and competitors sit based on key dimensions like price quality. The value chain breaks down your internal activities, R&D, production, marketing, service, to see where you create value and where costs are incurred. Helps find ways to improve.
And VRIO.
That's a test for your resources and capabilities. Are they valuable, rare, costly to imitate, and is the organization ready to exploit them? If you can answer yes to all four for a resource, it could be a source of sustainable competitive advantage. That's the key: sustainable.
And Soft Matrix helps think about growth.
Right. It lays out 4 paths. Sell more existing products to existing customers, market penetration. Sell existing products to new customers, market development. Sell new products to existing customers, product development. Or go for new products in new markets, diversification. Helps structure growth thinking.
And the business model canvas.
A very popular tool. It's a one-page template to map out your entire business model, your value proposition, customer segments, channels, revenue streams, key activities, resources, partners, cost structure. Great for visualizing, analyzing, and innovating your model.
So how do companies use these to actually get ahead and stay ahead?
Well, for competitive positioning, it means really mapping the landscape. Maybe finding that blue ocean, figuring out what capabilities you need, seeing if you have them or can build them, and then crafting that unique value proposition.
And business model innovation.
It's about rethinking those core elements on the canvas. Can we change our value proposition, our revenue model, how we deliver value, how we compete? Constantly challenging the status quo.
Strategy implementation is just as important as planning, right?
Absolutely critical. A great strategy poorly executed is worthless. Tools like the Balanced Scorecard help track progress beyond just financials, looking at customer perspective, internal processes, learning and growth. And strategic control systems help keep things on track, setting boundaries, monitoring assumptions, fostering dialogue.
Powerful stuff. Resources for strategy.
Michael Porter's competitive strategy is foundational. Kim and Mauborn's Blue Ocean strategy. Grant's contemporary strategy analysis is another good text. Online courses from HBS Online, Stanford GSB, YouTube channels like Strategy Bites or HBR often have good content.
Okay, well that wraps up our modules. Quite a journey through the core of an MBA.
Yeah, it was rapid, but hopefully useful. We touched on accounting as the language, finance for value creation, marketing for customer connection, operations for efficiency, and strategy as the roadmap. Frameworks and tools for understanding the business world.
And it's clear this is just scratching the surface. The real value comes from digging deeper and applying these ideas.
Exactly. The MBA gives you the foundation, but it's continuous learning and putting this stuff into practice that counts. Definitely check out some of those resources if specific areas caught your interest.
So a final thought for everyone listening. Think about how weaving these different perspectives together, finance, marketing, operations, strategy, might help you see things differently in your own work or investments.
Right. What new insights pop up? By looking through these multiple lenses, maybe you can spot that uncontested market space, that blue ocean in your own world. Something to chew on.